We just hosted our first ever hometown Investment Master Symposium in Sarasota, Florida. The early December conference featured a top-notch lineup of expert speakers, many of whom were generous enough to sit down and discuss markets with me on site. This week's podcast episode features one of those interviews with Alejandra Grindal. She is the Chief Economist at Ned Davis Research and a noted expert on global demographics, labor force trends, and domestic and foreign economy.
Looking at the short-term picture, definitely much better than where we were last year when you look at global inflation. Those global supply chain pressures, those COVID imbalances, they've kind of started to fix themselves out. And as you can see on the chart, the global supply chains pressure index really showed a nice inflection point for global inflation. However, the intermediate term, that's where things are being a little bit on the sticky side. In other words, we don't expect the world's major central banks to meet their inflation goals by the end of 2024.
Alejandra, how are you?
I'm fine. How are you doing?
Very well, very well. So you're the chief economist there, but I haven't had you on the podcast before. Why don't you just talk a little bit about your background and what it is that you're speaking about here at the Money Show?
Oh, great. So I am, as you mentioned, the chief economist at NDR. I've been at Ned Davis Research since 2006.
Okay.
And my job when I was hired was to take what we had in the U.S. economic service and just grow it for the rest of the world. So I started off international, looking at just developing stuff for China, for Europe, for Japan, and then now I've moved up to the chief economist role and sort of oversee where we are in the outlook. Prior to that, I actually used to teach macro and micro economics at a few colleges, and then prior to that was graduate school for economics. So I am like an economics lifer.
Got it, excellent.
Well, not many people they're like, you're weird.
No,
Who in their right mind would do that?
You have passion for your business.
I do,
That's wonderful.
I do.
That's
yes.
wonderful. So here you were talking about a little bit macro outlook, macroeconomics, inflation, global versus domestic. What are you seeing in this market environment as we talk here in December 2023, excuse me?
Yeah, at least for the time being. So at NDR, we come up with sort of more tactical outlooks, and then we also try to look at things more for the long term. But looking specifically at the end of this year through next year, there's some good seasonality for equities. It supports the fact that we're seeing low global and U.S. recession risk at this time. But going into 2024, we do see some downside risks to both the global and U.S. economy. The obvious being, the continued not that monetary policy is still tightening, but you have that long and variable lag and that delayed impact, and we just don't know how strong it's going to be next year. Geopolitical risk, less fiscal support, just not a whole lot of upside risk. However, we're not seeing enough downside risk to call for U.S. recession or global recession. So overall, just sort of making that argument of a soft landing, but to be cognizant of the downside risks and not underestimate the risk of recession.
Yeah, I'm glad you brought up the monetary tightening and sort of what impact that has, because so many people, you go back, wind the camera back a year, it was 100% chance of recession. I love that Bloomberg headline. It's on. People are a lot more concerned just given the magnitude of the hikes and what the Fed was doing. Why, in your opinion, has it not had more of an impact? Why have the worriers not been right?
Well, and I think that's one of the interesting things about me having been an international or global economist first, is many times you learn more about your home country when you see what's going on in other parts of the world. And so one interesting thing with the United States, and this was actually one of the things I briefly touched on my talk. I only got 20 minutes, which is hard for an economist. We love having a lot more than that. But that transmission of monetary policy hasn't been as strong in the United States. First, from the household perspective, is those debt service ratios remain quite low because most of us locked in these really low fixed interest rates for our mortgages, and we're able to hold them for 30 years. And so even though interest rates are going up for auto loans and credit card loans and the delinquencies have gone up, the vast majority of household debt is mortgages. So it's kept that ability to service that debt quite good. Job markets remain tight. Part of this is a product of the fact that the labor force hasn't fully recovered from its pre-COVID trend. So that's been sort of driving things in a positive direction, very different from what we're seeing in some other parts of the world.
Got it. And I'm glad you brought that up because I know you just were traveling Asia and Australia and so on. I'm kind of curious, what are you hearing from clients overseas? What are their views on the economy based on what they're seeing there, and what are the kinds of questions you're hearing about the U.S.?
Yeah, so I didn't get a whole lot of pushback with our outlook where we see, slower growth next year globally, but not like a complete falling apart, that soft landing scenario. So not much pushback there, but it was interesting to hear the question. So one of the things I usually touch on in my domestic presentations is the U.S. fiscal debt situation. How did we get there? Why did we get there? What are the implications for the dollar? And I usually just keep that in my US-based presentation because I figure, that's more something that you'll have here. And I actually took it out of my presentation to kind of give more of a global scope, and the vast majority of people asked me about it. Okay. So that was really interesting too, that's such a hot topic of discussion. The political view here in the United States, that was also big because that can have fiscal implications. So I was actually surprised by that. And then, of course, the other question we get a lot, and specifically because I was in Asia, hugely driven by the world's second largest economy, which is China. And so they have their personal outlook on China, but they're always interested in what is the U.S. perspective on the Chinese economy and in China in general. Because at the end of the day, what drives Chinese equities on the margin is whether the Western world gets in on it. Sure. So if there's a negative view on the Chinese economy, or just broadly speaking from political implications, it's hard to see Chinese markets outperform. Okay. So I thought that was really interesting.
Right. Yeah. And when you look at the inflation picture, I know your talk here pointed out it's improving. Some of the supply chain stuff has sort of worked its way through the system. What do you see happening as we roll into 2024?
Yeah, that's the tricky part, right? So we've seen kind of, I would say, the easy work be done, and we're still seeing stickiness on the services side, and this isn't just in the United States, but also in other parts of the world. And a lot of this stems back to, this relative tightness in the labor market, wage growth being strong, and that creates feedback loops into services inflation. And then another key element, even with US inflation, and we do expect this element to slow, but it just hasn't slowed that much, it's the housing component. So remember, shelter makes up 30% roughly of the overall CPI, about 40% of the core. And because of those strong household debt service ratios, people aren't leaving their homes, and housing prices have remained pretty resilient. So that impact on services inflation from the shelter component hasn't been quite as downside or as strong as we had anticipated. It's just creating a nice foundation there.
Got it.
If you want to call it that, yeah.
There you go. Now, let me ask you this. I mean, obviously, a lot of people here are investors. They're interested in the economics, but in terms of what impact it has on markets. So, Ned Davis, your outlook seems to be fairly positive, right, for the future. And can you maybe expand on that a little bit? What where you see some opportunities, where you think, from an economist standpoint, it's going to be riskier in the markets?
And I think, well, you answered my question for me. So, one of the things I showed in my presentation is that you typically don't get equity bear markets unless there's a sustained global slowdown in economic activity, and even worse if there's global recession. As I said, that's not our base case scenario. But it's not a great outlook either with the geopolitical risk and the monetary policy. So we do expect equities, again, I do want to point out the caveat on NDRs. We're very model driven and we're very nimble. So if we start seeing things turn, then it could be very different from what I say now. But ultimately where we view things is we still see positive returns on equity, but increased volatility because of those risks. And also the fact that we're in a more mature stage of the expansion and the equity cycle, and you just don't see quite as much upside as a result.
Got it. Okay. All right. Any last minute things I didn't touch on? I mean, I know when you were talking about your inflation outlook, there's some of these things, de-globalization and demographics and so on, that are going to keep things stickier, I guess, longer term in inflation.
Oh yeah, that's a really great segue, because I will say that was another, it's almost like I asked you to ask that. One of the other questions that I got down in Asia was, where do we see things headed? And if you actually look at de-globalization or so-called de-globalization trends right now, many people focus on global trade volumes, which just haven't been growing as much as they did before the global financial crisis. But what we did was we looked at how trade has become more or less important among various economies. And in most cases, in the developed world and among the world's largest exporters, it's actually become more important. Okay. So the de-globalization, when you actually break it down by country, is actually happening with China. And so what China is doing is, over the past 15 years or so, it's been internalizing its supply chains. So back in, say, 2007, 2006, nearly half of its exports were made of imported goods. Today, it's less than 10%. And so that literally reduces global exchange transactions, because you're not having that in and out transaction of that final good. So, it's kind of debunking that myth. However, going forward, foreign direct investment trends can sort of tell you where the future of globalization is. And you can also hear a lot of anecdotal stories too. And ultimately, we're seeing more indications of ally shoring and friend shoring, where foreign direct investment trends are going a lot between, say, the Western world to, say, Latin America, as well as South and Southeast Asia. And one of the key takeaways I had when I was out in Asia over the past week was there is so much optimism and investment going to South and Southeast Asia, and some discussion of Latin America as well. So it's nice that it's being corroborated across the board.
Got it. Well, I really do appreciate you taking some time out here at the symposium. Enjoy the rest of the day.
Thank you.
Please, everybody, check out Ned Davis Research and the work that Alejandra does. Take care.